So after all these discussions, we can understand that the contract between the Islamic bank and fund provider and fund user, that means the customers, the contract between the customer and the Islamic bank actually relies on some very important pillars. Number one is prohibition of riba, that means interest. Number two is sharing of equity contribution. Okay, so by a prohibition of interest, as you already know, that it is the strict prohibition from any involvement in riba based activities, whether in terms of paying or receiving. So no matter whether you are paying or receiving, there should be no interest at all. And another pillar of the Islamic banking contract is sharing of equity contribution. Okay, so because riba is prohibited, now what should be the basis? If you think about the conventional bank, actually their contract is materialized, or the people are interested to engage into the contract because they will get something, some kind of interest. A bank is also interested to give loan because bank will get higher interest from the customers. But if that interest is prohibited in Islamic banking, then what should be the basis of contract? Why the Islamic bank will be interested to engage into contract with the customer, and why the customer will, on the other hand, be interested to engage into contract with the Islamic bank? So that is basically based on the equity contribution. That means sharing of profit. If they can make profit jointly or individually, through financial and non-financial contribution, if the profit is generated, and that profit can be shared between the customer and the Islamic bank, and that can be the point of attraction of why the customers will be interested to engage into interest-free contract with the Islamic bank, and Islamic bank will be interested to engage into interest-free contract with the customers. Okay, so what happened in this case is the supplier of fund, that means the investor, and the borrower, who is the entrepreneur, they are required to share the profit and risk arising from the transaction. Okay, this is called the profit and loss sharing contract. So this is the heart of the Islamic financial contracts or Islamic banking contracts. Now, if we think about, these are the two, we have more. So the third one is, the third pillar of Islamic banking contract is money is considered a medium of exchange. It is not a commodity. It is not an asset. It is not something consumable. Okay, rather it is considered a medium of exchange. It is merely like token or something like that. So you should not make any token out of token. That is the thing. So money is considered a medium of exchange in the Islamic banking contracts. So money should not generate money on money, something like that. Okay. Instead, money should be treated as capital, and any profit or loss must be shared between parties as per the proportion of their investment. And these transactions must be backed by asset. There must be some kind of asset in behind, asset based or asset backed. Contract should not be entirely based on money. Money should not only produce money. Rather, money should be transformed into asset, productive asset. Assets will produce something, generate profit, and that profit will increase the money. This is the main principle. This is the pillar of the Islamic banking contract, in contrast to what is happening in case of conventional bank. Okay. The fourth pillar of the Islamic banking contract is, again, prohibition of gharar or uncertainty. So excessive uncertainty and speculation, that means taking a position based on the speculated future, predicted future. So excessive uncertainty and speculation must be avoided. It must be avoided because these lead further to gambling, actually. So whenever there is a tendency to take more and more uncertainty, ultimately it may translate into some kind of gambling, which is also prohibited. Yeah. So this is the thing. that in the Islamic banking contracts, we avoid the complete uncertainty. And the purity of contract, that is another pillar. So what we mean is clear disclosure in order to reduce the risk of exposure to the contract. So disclosure, everything should be clear. Everything should be clear, and legal in the eye of Sharia, Islamic Sharia. So Islamic banking transactions should be based on very strictly and clearly mentioned terms and conditions. It should not be that much uncertain. Okay, so these are the pillars of Islamic banking contract.